spot in the mortgage market? Join us for another episode of FDM Brews to learn more about trends and updates in the mortgage industry that can help you get your clients pre-approved for the home of their dreams.
Good morning, gentlemen. It's good to see you again.
Good morning, Cindy. You see this? Coffee's closers. We're going to learn about closing today.
Yeah, coffee is for closers. We got to keep it jazzed up, keep the caffeine flowing here.
Absolutely.
So tell me what we're talking about today.
Well, Cindy, what we're going to talk about today is what happens when the market normalizes, right? 2020, 21 were just ridiculously crazy years in the real estate business, right? But at some point in time, right, the market's going to normalize. You know, we want to be careful about what words we use. We're not going to see a crash. We're not going to see a correction. We're going to see a normalization of the market. Well, when the market normalizes, right, and it's not where I have a listing and I got 7,213 offers in an hour, right, and everybody wants to pay cash and they're bidding over top of each other, right? That's not reality, right? That's 2020, 21. Really unique things happened that created that kind of real estate boom. What happens when the market normalizes, right? What happens when we have to solve some of the challenges that have been historically associated with homeownership, right? So we're going to talk about that. We're going to talk about how to build that prospect funnel for when the market normalizes, right? One of the things that salespeople need to understand is I'm booming right now, right? But what happens when the market normalizes? I don't want to start building my prospect funnel then. Wait a minute, market slowed down. What do I do? Well, no, that's not what I want to do. What I want to do is I want to start building those prospects now. Now, they might not be an April prospect, but that's okay. I still want to sell houses in December. I want to still sell houses in January of next year. So let's start building that prospect funnel. So we're going to talk today about Jerry Maguire and show them the money. Do I need to jump up and down and get my phone and yell at Rod Gabriel?
I think we need a better Jerry Maguire impression.
Exactly. We're going to show them the money. And that's what we're going to talk about today, right? How do we do that? How do we create opportunities for when the market normalizes and make sure that you have a prospect funnel that's full of buyers ready to buy with the money available to them? And that's what we're going to talk about today.
Perfect. Well, let's bring up the good stuff here. Get the
All righty. Well, we're going to talk about show them the money. We're going to talk about solving the biggest home ownership challenges. Now, what's interesting is, hold on, let me get this up where I can move it. All right. The two biggest challenges to home ownership. Cindy, when we talk about the two biggest challenges to home ownership are, what do we think they are, right? They're two things: challenge credit and no cash, right? It hasn't changed. Now, first off, words matter, especially when we're dealing with folks coming into the marketplace. Nobody really has bad credit, right? When you tell somebody they have bad credit, that's a defeating verbiage, right? We have to be careful how we communicate things. People have challenge credit. They have to work through this. These are things that we can get through. When you tell somebody they have bad credit, they get defeated right away. So get that out of your nomenclature. Everybody has challenge credit. The next biggest issue to home ownership is no savings or cash to close, right? When I do this in person, I just ask everybody, how many of you have a client that would like to buy a house and have no money? And they all stare at me and I say, everybody raise your hand because you do. Those are the two biggest challenges to homeownership. Now, as we had talked about in previous classes, I've been in this business for 31 years. Now, when I started in this business, 37 years. Goodness gracious, I'm old. But when I first started in this business, the two biggest challenges to home ownership were, challenge credit and cash to close. In 37 years, it hasn't changed. Right? In 1985, challenge credit and cash to close were the two biggest obstacles to home ownership. In 2022, challenge credit and no savings or cash to close were the two biggest challenges to home ownership. Now, last 2 years have been crazy, right? What do we do when we come out of what I call the COVID tunnel, right? What do we do when the market normalizes? What do we do to make sure we have buyers and prospects ready to buy a home and we have them positioned to do that? Now, mortgage rates are at historic lows, and this is important. And I bring this up because if you the blog that I sent you for this week is, rates are going up, right? The Fed had their meeting yesterday. They basically said they're going to raise interest rates 7 times. They raised them 1/4 point yesterday. They have planned 6 more rate increases this year, and the futures market seems to think that's going to happen. However, if we go from 2.5% to 5.5%, rates are still at historic lows. So look at this time period. I told you here, look at the very, very top here. In the 80s, I bought my first house, actually, in 1979. The interest rate was 22%. Now, the reason I bring that up is because people say, well, 5%, that's high. Well, try 22%. And by the way, Cindy, if I ask you a question, what were people doing in 1979 and 1980 when rates were 22%? What do you think?
Saying, wow, rates are high. The same thing.
They were saying rates were high, but they were buying houses, right? I just bought one, right? So that just shows you rate really doesn't matter. People will buy for different decisions, right? We get focused on rate, but the reality is, even at 5.5%, rates are still at historic lows. Now, they're not at the lowest point, but they're still a lot lower than 22%, right? So this is something we want to keep in mind when we talk to buyers who are going to buy later in 22 and maybe the early part of 23. Rates are going to be higher, but they're still going to be affordable, and we want to focus on that. So let's get that out of the way. Rates are still at historic lows. Yes, they're going to go up, but rates will remain at historic lows. They're not 22%. 5.5% is a lot better than that. So let's talk about the challenges. Well, the first challenge is, where is the money? Now, I have this shot. This is a 2020 Fed survey. We don't have the 21 data yet. When I get this, I'll update the slide. But when you think about this, look at where the majority of the population is, right? So almost 18% of the population of people that we can buy have less than $500 in the bank. Now, most of you are looking at that person and going, yes, prospect. Well, maybe they are a prospect, right? Another block, right? You're talking almost 14% have less than $1,000. Once again, you're looking at them going, wow, prospect. Well, maybe they are a prospect. And look at the next one. The biggest one, by the way, is less than $5,000. 22% of the American population has less than $5,000 in savings, right? This is where the bulk of the people are in the marketplace, right? You're looking at here. Now, in Naples, it's kind of like an anomaly, right? 53% of the people in Naples pay cash, but only 4% of the population have more than $100,000 in cash available, right? So where do I want to be when the market turns? Do I want to be here, or do I want to be here? I probably want to figure out how to meet the needs of this client that doesn't have any money, right? And we think about now, Cindy, it's even more difficult to save money. Student loan payments, car payments, rent is ridiculously high, and it's getting higher, right? You don't get any tax benefit for renting. So how do you save money? Well, that's kind of the catch-22 folks are in, right? My living expenses are making it more and more difficult for me to save the money to buy a home, right? So that's why challenge credit and cash remain the two biggest challenges to homeownership. So what we want to talk about is, how do I meet the needs of this segment of the market, right? To the people to the left of this graph, right? Not to the people to the right. We already know how to meet those needs, right? So how do we meet the needs of them? So let's talk about concepts and strategies on how we're going to do that. So there's a great book called OPM. Nitish, Cindy, what's OPM? What's it stand for?
Other people's money.
Other people's money. Absolutely, right? There's a great book about that. This is the key to building wealth that most people do not know about, right? There's a great book about it, and people think, well, that's a sophisticated financial strategy. But in the majority of the transactions that we do, our buyers are using other people's money. Most people get a what? Mortgage, right? That's actually other people's money. That is the bank's money, right? Or the mortgage company's money. So OPM is a very effective tool. We just don't learn about it, right? It's a great book, right? You should learn about it. But we don't understand how to make that happen for us simply buying a home. And that's what we're going to talk about. How do we create that leverage so we can help people buy their first home? So, Cindy, in other classes, we've talked about this. I like following the smart money. I like following smart people, right? I sit there and say, okay, if it worked for people that are a lot smarter than I am, then maybe I should think about how I do that. So everybody knows who Warren Buffett is, right? One of his best quotes is, when leverage works, it magnifies your gains, your spouse thinks you're clever, and your neighbors get envious. Now, it takes a lot of work for my spouse to think I'm clever. So what is leverage? Leverage in a financial deal is debt. You use other people's money to allow you to control a larger investment than you could on your own. Now, take out that segment of the population in Naples, Cindy, that's paying cash, right? Let's focus on the half that are not. And maybe we can make that half bigger as the market normalizes, right? Leverage is debt. Well, what asset am I buying? I'm buying a house. That's a larger investment that I can make on my own. Most people aren't writing a check for 500,000 or 600 or $1 million. In your market, there are, right? But half of the people aren't. So they're buying an asset. They're using a lever, which is debt, to do that. That's other people's money. Now, what if you could create a lever that's not debt, has no interest charge, requires no payment, and is only paid back with future dollars? Wow, that sounds actually pretty good. I can get other people's money. I don't have to make a mortgage payment. I'm not paying interest on it, and it's only paid back out of future dollars or even forgiven. Wow, that kind of sounds like what? Free money. This lever allows you to purchase a larger asset, a home, with lower payments and diversifies your asset. Actually, if that works for Warren Buffett, maybe I should figure out how to make that work for myself. And that's what we're going to talk about today. So when we do this, and this is just a refresher course because we get lost in this. And, one of the concepts we talk about is move the money around, make the deal. And I just want to reinforce that because in the last 2 years, we've kind of lost thought of this because I hear it all the time. Well, this person's not going to pay this or this person's not going to pay that. You're right. In 2020, it didn't happen. In 21, it didn't happen. It's not happening in the first part of 2022. But the market is going to normalize and it's going to happen again. So what we want to do is brush up on that skill set, right? It's like that book, 7 Habits of Highly Effective People, right? Sharpen the saw. When do you want to sharpen the saw? You want to sharpen that saw now. We want to brush up on some of these skills that help us to be successful. So who can pay in a real estate transaction? Obviously the buyer, right? The second, the seller. Now, right now, people are saying, well, the seller's not going to pay. Okay. Today, they're not, right? But is today way the market's going to be over the next 3, 4, 5, 6 years? No, it's not, right? 2020, 21 are an anomaly, right? At some point in time, the seller will participate in the transaction again. Historically, even in Florida, the seller would pay the 3 to 4% in closing cost assistance to help make a deal work. At some point in time when the market normalizes, that's going to happen. The next person that can help is a lender, right? We do it all the time. We agree to do it for every DF deal, but we'll do a lender credit for part of the fees for the buyer, help covering some of the DF fees, right? That's a lender credit. So the lender credit can pay in the deal. The second is the community grants. Now, this is what we're going to talk about today because these are a misnomer, right? There's money available to help people buy a home, and you don't have to have low income. What you just need to understand is how to do that. So these are 4 people that can help in the deal, right? We want to talk about who can pay and how to move that money around and make the deal. Now, let's talk about investments. Like what we want to talk about is how does this work best for our buyers? So let's talk about what's happening. By the way, I teach a class called Word Matter. I'd like to do that for DF one time, but let's talk about investment versus expenses. First thing is down payment equals investment. I strongly encourage as the market normalizes, because we want to keep our buyer focused, that instead of using the word down payment, you use the word investment, because that's really what it is. Instead of saying, well, you need a 3.5% down payment, I'd say, no, you know what we're going to do? We're going to make an investment, because that's what you're buying, right? You're making an investment. You're buying an asset. We're going to make an investment of 3.5% of transaction because that's what your down payment is. Closing costs, right? Closing costs are expenses, right? They're the costs associated with buying your real estate. What I'd like to do is figure out how to use other people's money to pay the expenses so my money goes towards my investment. And escrows, which are prepaid expenses, right? Those are prepaid expenses. So let's look at a real estate transaction, right? Most people have to come up with money they don't have, right? Most people don't know how to apply the money that's most beneficial for them. And that's what we're going to talk about today. So the question is, Tish,
Do you, right? And, we ask these questions when we do a live presentation and everybody raises their hand. Everybody knows, folks out there have a prospect that would like to buy a home, but has no money. Everybody should be thinking of people right now, right? They've dealt with folks and they should immediately have some names that they should jot down of people that are interested. They're in the market, but their only roadblock is money. They don't have the money to buy. Have a prospect paying over $2,000 in rent per month. We talked about how rent prices are going up, and it's hard to find a property that's renting for lower than $2,000 right now. So if you can buy for equal to or lesser than what you're paying in rent, you should be buying a property, right? Do you have a prospect who wants to buy a home but has too much debt? The incoming home buyers, first-time home buyers coming into the market, they already have a high level of debt in the form of student loans. Student loans at their highest it's ever been at $1.7 trillion in the US. And so, they're reluctant. A lot of folks don't think they can qualify for a mortgage because they think they have too much debt already. But there are options around that. You have a prospect looking for a house to rent. Well, again, if you can buy and pay the same or less than what you can for rent, you should be buying, right? Do you have a prospect with challenge credit that wants to buy a home? Well, credit does not stand still. If you have challenge credit right now, it doesn't mean the credit's going to stay that way for the next 6 months or a year, or even the next 30 days. Credit is constantly changing. So if credit is your concern, well, talk to us, talk to your agent, talk to the contacts that you have, talk to the professionals because credit can be worked on. Your credit now can be very different from what it looks like 30 days from now. Have a prospect whose lease expires in 2022 rather. The mindset is, and this is how people work. My lease is expiring in December. I'll start looking in November. Well, no, that's not how the market works, right? You want to be looking now if you want to. And we've seen it in the last 2 years. Folks are putting in 10, 15 offers on different properties before they end up actually getting a contract. And, so you have to start looking now to make sure that you have a contract by the time your lease is expiring, because otherwise, if you start looking in November, you're likely signing another 12-month lease. Right?
Or worse, you're signing a 3-month lease at even
Yeah,
higher rates,
exactly.
No.
They're going month to month, which is much more expensive, right? Shorter terms, month to month. Absolutely right. And then the last question is, do you have a prospect that wanted to buy in 2020 or 2021 and could not? Well, you have a list of prospects. Brett talked about creating that funnel of prospects and not waiting until the market normalizes. Well, you've already spoken to uh, folks who are interested and they wanted to buy, but they couldn't for whatever reason. Well, bring them back. Think of those names again, write them down, and reach back out to them and figure out what you can do to help those who are interested.
Yeah, a couple points here that I think it's really important, right? So when you look at the issues here, first thing is having any prospect that's looking for a house to rent, right? If you told them, hey, if I could show you how to buy a house today for your first month rents and security deposit, what should you do, right? You should look at buying a house, right? The second thing that you're talking about, and I think Tish brought it up, is you had a prospect, any prospect that wanted to buy a home in 2020 or 21, and you couldn't get them by. And you can't judge, Cindy. You just need to write them down. And we encourage you to do this. Write them down. Did they have challenge credit? Did they have no cash? They were pushed out of the market because sellers wouldn't help with closing costs, right? There's a lot of people that were pushed out of that market that want to buy. And it's important that we get to them now because they're going to re-engage into the market. But there's no guarantee they're going to re-engage with you unless we start reaching out to them and give them a plan. The other part with challenge credit is you tell somebody, by the way, nobody is on a credit repair plan right now. When you're looking at some of the outlying markets outside of Naples and Marco Island, right, you're going to have first-time home buyers coming to the marketplace. Nobody's on a credit repair plan. They are always on a homeownership plan, because when you have somebody that had challenge credit and you help them improve their credit a little bit, and then they get their first credit card offer, they go, yes, big screen. No. We're not fixing your credit. We're getting you on a homeownership plan. But here's the challenge most people have. It's right. We talk often about time and motivation equals homeownership. You get them on a credit repair plan, on a homeownership plan that includes credit repair, right? So you're in a situation where you're getting them in the situation to buy, and you say, great, your credit's got to the point where you qualify. Now all you need is $30,000. Well, they're not motivated, right? At that point in time, they're saying, oh, wait a minute, I'm not motivated to buy a home because I don't have the money when you get there. But when you tell them, hey, when you get there, there's $30,000 waiting for you to buy, right? All of a sudden they're motivated. They can see that brass ring. So that's really what we want to talk about. So when you look at these questions, right, you ask yourself, do you have them? Don't judge. Just write the names down, write the emails down, write the phone numbers, and let's start reaching out to them, because we're going to talk about how we become closers. We all get coffee because we're going to move the money and make the deal. I kind of feel like Monty Hall for let's make a deal, right? I should hold this sign up. Move the money, make a deal, right? Maybe Monty Hall will pick me. I probably just aged myself because nobody knows what let's make a deal is. So
no, I know, and I'm an '80s baby. So, before we move to this, I love this. I want to make sure that last point was really clear, because my marketing brain just picked up like, okay, you've got these prospects here, and you want to re-engage them. You want to get them in the funnel, and you want to get them on that home ownership plan, right?
yes.
If you are a real estate agent and you don't have a listing right now, and you're building that prospecting funnel, what a perfect reason to call some of these past prospects, and just talk to them about, how can I connect you? How can we start building this so that when the market conditions normalize, we can get you into that house of your dreams? And so that's such a different marketing approach than what I'm hearing. I've gotten like 10 phone calls from a guy trying to buy a property that I'm not even associated with. And it's just missed marketing. But this is so on the money with engaging people that are on that fringe that could be, and if you help empower them to get past their challenged credit.
Yeah, I think, Cindy, that's brilliant, right? We, as sales professionals, we focus on what's happening right now, right? What transactions do I have in my pipeline? What am I going to close? To use Eddie Murphy, right? I want to have the money to buy the G.I. Joe with the Kung Fu grip, right? So I'm going to focus on what's closing today. So, but superstar performers are, hey, where am I going to be in December? Where am I going to be in April of next year, right? We build the concept of prospect funnel. So we have all of these people that were pushed out of the market for whatever reason, right? They want to buy, right? They haven't lost that motivation. They may be discouraged right now. So what we want to do is reach back out to them, encourage them, and say, you know what? Maybe April's not going to be the time for you, but you know what? The market's going to normalize. Let's position you for August, or let's position you for December. Let's get you ready to do that. And we're going to show you how to do that. That's a big key to ensure success for us as the market normalizes. We don't want to do this when the market normalizes. We want to do it now. So when the market does normalize, I have this prospect of funnels of people ready to buy, and I'm prepared to help them do that. How do we do that?
You move the money and you make the deal. And Brett had put out a blog earlier this week with this exact topic. So you have the money, but you can move it around to make bigger things happen. In the market that we're in right now, if you put 10, 15 offers on different properties and you're asking for seller credit, this is not the market for that. Sellers have an advantage right now. They don't have to give seller credit in order to get a contract on their home. And you may have a buyer who has the money for the down payment, but they don't have the money for closing costs. Instead of asking the seller for credit, let's move that money around. Move the down payment money, and you can pay for the closing costs, and use down payment assistance to pay for the down payment. Now you have used your own money to make that deal happen. And as Brett mentioned, use OPM, right? Other people's money for the down payment. Now you have other scenarios where, folks may think, hey, I want to buy, but I have too much debt. Well, you have money for down payment, but again, you may not have enough, or you don't think you have enough. Well, use the money you have and pay off debt so that you can qualify, and use down payment assistance to cover your down payment and closing costs. Now you have lowered your debt, so you're in a better position than you were in before. You've actually, in the process, lowered your debt, and you've bought an investment. You've bought a new home for yourself, right? And the third part of it is, folks have great income, and they may be looking for a bigger home than what everybody's saying they qualify for. Well, so what do? I have, let's say, $15,000 that I can pay, and with $15,000, I can qualify for X amount. Well, let's increase your leverage. Let's get you down payment assistance, and go from 15 to maybe 30,000. Now you have more of a buying power. Instead of qualifying for a $300,000 property, maybe you qualify for a $500,000 property. Everybody wins. The buyer gets what they want. The agent gets a better deal, which means more commission. It's not a bad thing. Money is not a bad thing. Commission is not a bad thing. Brett always says it's not a nonprofit that you're working for. You're in this to make money. Don't be ashamed of it. So getting your buyer that additional money to get them what they want, and as a result, you're getting a bigger commission. Everybody wins, right?
Yep. What's interesting about move the money, make the deal, Natisha brought up 3 really good points. First off, words create limitations, right? When we hear down payment assistance, right, we automatically defer to, well, it's down payment assistance. That's all I can use for the down payment. Well, I have a down payment, so I don't need down payment assistance, right? Words have limitations, so we have to think outside of those. So that's the first thing, right? Down payment assistance can be applied in different ways. So the first thing is, think about how many people had the down payment and they kept making offer after offer after offer because they were asking for selling help for closing cost. Well, wait a minute, you never needed to do that. Use your money to pay the closing costs. Now I can make an offer. I'll pay 100% of the sales price. I don't need any seller help. Use the down payment assistance to pay for the down payment. Use your money to pay the closing cost. You're not asking for any seller help. Deal done, right? Move the money, make the deal. The second one is really important, especially for first-time home buyers, Cindy, because debt is a big issue, right? It's just very difficult for people now to save money because they have too much debt, whether it's student loan debt or consumer debt. And what's happening when you look at a holistic, and I do a lot of work with financial advisors, right? So how is money applied? Now I have too much debt, but I have the money for the down payment, but I've got a 60 back ratio. Okay, that's not going to work. You're not going to get approved. Well, maybe we take your money that you were going to use for the down payment and we pay off your debt. We're going to pay off your credit card debt. We're going to pay off your car debt. Right now, we're going to lower your ratio, and then we're going to replace that money with OPM, other people's money, and use that for a down payment. Now, why is that important for a client? Let's look at their financial picture. What just happened? Consumer credit is not tax deductible, right? Credit card debt is high interest, non-tax favored debt, bad debt. When we do the credit class, we'll talk about good debt, bad debt, right? So non-tax favored, high interest, it's bad debt. So if I paid that off with my money and replace that with other people's money to get a mortgage, which is low cost tax favored debt, I've just improved my buyer's cash flow. That's smart financial planning, and I'm helping them better prepared for homeownership. If I paid off non-tax deductible consumer debt, I improved my borrower's cash flow and helped them buy a house, right? So let's look at a holistic way to make this work for my buyer. Pay off their debt, use the other people's money, down payment assistant, now to give them the money to buy a home. That's a brilliant strategy. I've improved their cash flow, made it cheaper for them to buy, and I got them on that path to real estate. The other one, I have the income, right? Because income's growing, but I don't have the down payment. So I'm priced out of this market. Everybody's chasing this 450 market. Well, I have the income to qualify for a 650 market, but I don't have the cash. Well, let's give you the cash. We're going to turbocharge your buying power. So move the money, make the deal. All we have to do is think outside of the box, right? What's interesting when you look at financial planning, right? There's always asset allocation. We're going to talk about that in another class that we teach, asset allocation. But there's a concept I call asset application, right? How I apply those assets is just as important as how I allocate them and saving them. And this is what we're talking about, right? How do I apply those assets? Now, one of the assets I have is other people's money. How do I take that and use that to our advantage? So that's what we talk about when we say move the money, make the deal. Now, why is that important? What's happening in Naples, Nitesh?
Rent is going up. In Naples and all the surrounding markets, rent is going up. And the national average right now is $1,500, around 15, closer to $1,600. Naples, it's over $2,400. And as we discussed earlier, if you can buy and have a mortgage of equal to or less than what you're paying in rent, would you be interested in buying? Everybody should say yes, right? Less than $1,100 square foot apartment costs about $2,400 to rent. You can buy a property that's likely larger and pay less.
Yeah. What's interesting here, Cindy, is, obviously it's been a hot topic in the news, inflation, inflation, inflation. One of the things that's underreported is rent inflation. So according to the single family rent index, rents are going up 4 times faster in 2022 than they did in 2020, right? So rent inflation is happening. So even if you're here now, what I can tell you is that average rent is going to increase, right? That's on the up escalator. Now look at the red line. This is Naples rent, right? Look, it's been relatively flat compared to the national average. And all of a sudden, what's happening over the last year, right? Wow, that's a huge gap. And you know what's going to happen to this red line? It's going to keep going up, right? And it's going to go up faster than the national average because there is a supply and demand issue on rent. So what I can tell every buyer watching this and every agent that works with a buyer, rent's going to get more expensive, and you want to make these changes now. We want to get these paths on a path to approval. So what solutions do we have? We actually have 2 solutions that we want to go over with you. One is unique to us. Actually, they're both unique to us. The first one we do in it's kind of unique for an independent mortgage banker to have that, and that's our partnership with the Federal Home Loan Bank, and this provides a solution.
Yeah, so FHLB is one of the popular solutions that we have, and we will go over the other one as well. With the FHLB grant program, it's focused on first-time home buyers. There are a lot of community partners that can get a benefit out of this as well. And after COVID hit, it broadened the folks who could qualify for this. They have to have a minimum contribution of $1,000, but they can get between $7,500 to $10,000 towards their purchase. And you had law enforcement, you had teachers, firefighters, healthcare professionals that could qualify for this. Now it's expanded, and they've opened it up to COVID-related essential workers, and it includes folks in the financial industry, folks that had to be active while COVID hit, and they didn't have the luxury of staying home and working. They had to be out there. Banks were open, so tellers were working, and tellers couldn't qualify for this previously, but now they're included in that. It's really helped a lot more people qualify, and it's for, again, first time home buyers, and it's for primary home purchases.
Now, the community partners, right, the COVID related, they do not have to be first time home buyers.
Correct.
Which is a new development, and they're trying to support the people that were in the COVID part. So that's a $10,000 grant. The first time home buyer grant is a $7,500 grant, but a lot of people now qualify. A grocery store worker. Community partners was normally first responders, teachers, medical professionals, but this got expanded to COVID related, and a lot of folks, if you worked in a gas station or you were a grocery store clerk, you had to be a COVID worker. You had to be out there working, and we want to help people support that. So this is a unique program, and it's available to people looking to buy a home in Florida.
Yep, and a couple of things that Brett touched on. So there are 3 different aspects to this. First-time home buyers can get up to $7,500, and the community partners that Brett listed can get up to $10,000. They do not have to be first-time home buyers, and they can still get up to $10,000 in grant. And then there's a rehab program as well for owner-occupied residences that can also get up to $10,000.
What's interesting there, and you'd have to reach out to Nitish, is that a COVID-19 disaster area, which we can look up for you, does qualify for the $10,000 rehabilitation grant with the FHLB.
So FHLB, some of the guidelines, again, must be first-time home buyer. That's one of the sectors of the program. Now, the program does cap you at 80% of the average median income, and it's household income. So, if you have a child who is 18 or older and is earning income and living under your roof, their income does get counted into that income cap. So, if you're married and it's just the wife that's applying for the loan and the husband is working, the husband's income may not be calculated as qualifying income for the mortgage, but their income is looked at to qualify for the grant. Okay. Minimum credit score, 640. And that, you have a big section of the market that have challenged credit that Brett mentioned. They have 640, 660, and they can still qualify for these programs.
So this is one program that we have, Cindy. It provides a $10,000 opportunity, and that a lot of people can use $10,000 to help them get into their home. There are some limitations there because of the AMI cap, but we're going to show you a program that we have that is actually a turbocharged version of this program, and we're pretty excited about it because it's a grant program that doesn't run out of money, and it creates opportunities for buyers right now.
All right. And yes, as Brett mentioned, so FHLB, because it is a very popular program, and it's federal, so it does tend to run out and it gets replenished. And while it's being replenished, the program is not offered because they need to get the money back before they can offer it out again. But this program, it competes with FHLB, and it starts with 640 minimum credit, same as the other one. However, the income cap is a lot higher. Instead of being at 80% of the median income, this actually goes up to 160% of the median income. And it's not household income. It's only the income of the individual, or, if it's husband and wife applying, it's only the folks that are on the loan whose income get looked at. Now, the same scenario I gave earlier. If husband and wife are both working, but only wife is applying for the loan, we are not looking at the husband's income. If wife makes, as you can see on the screen, Collier County, that 160% is at $134,000. So if wife makes 120 and husband makes 120, and wife is applying by herself, then we're only looking at that 120,000. And as long as that is below the 134, you're fine. You can qualify. We're not looking at the husband's income and, qualifying out. That's not where the cap is. Now, the county limits are looked at. This is paired with FHA. So the FHA county limits are looked at. Collier County is 552,200, and the surrounding counties are at 426,80. Debt to income is expanded to 50%. You can have up to 50% debt to income ratios and still qualify for this program. Whereas a lot of county programs and a lot of other grant programs cap you at 40%, maximum 45%, but this one goes up to 50% debt ratios. There's no asset test, so you don't have to have a particular amount in order to qualify. No minimum requirement. You get up to 5% of the loan amount as free money. It's a grant that you get. It's free money. You are required to stay in the property for 5 years, but you don't make any payments to that grant for those 5 years. And after 5 years, it's forgiven. Sellers, on top of the 5% that you get, sellers or third-party agents, sellers, they can still pay up to 6% on top of the grant. Buy a home today, no down payment and no closing costs. Again, we talked about the obstacles that you have. Think of those folks you dealt with before that had roadblocks. What are those roadblocks? If cash was the problem, here is an easy solution. You do not need to be a first-time home buyer for this program either. You cannot currently own a home. You just can't own a home at the time of closing. So if you sold your home last month and you're buying a new home now, you can qualify for this program.
It's really important. Two things on this one, Cindy. First off, in the grant, right? We're talking about this, and I had this highlighted. It's free money. So let me just help everybody understand this, right? I'm a banker, so I'm not really good, but so say it's a $400,000 purchase price, loan amount. We give you a 5% grant. That's $20,000, right? That can cover your entire down payment. Now, if you live in the house for 5 years, most people live in their first house for 7. You don't make a payment. There's no interest charge. And at the end of 5 years, it's forgiven. So, Cindy, if I was to walk up to you and say, here's $20,000 to help you buy your home, what are you going to say to me in most cases?
Thank you.
Thank you very much. That's what people are going to say, right? So think about what that is, right? And that's really what it is. It's us giving them $20,000 to help them buy their first home, live there 5 years, and it's free. no interest, no payment, free money, right? Think about this, free money. If you're walking down the street, somebody has you $20,000, you're going to go, yes, I'll take that $20,000. Now, in a normal market, and say 2017, 2018, because we've been doing this program for a long time, we had buyers go to settlement. We gave them the entire down payment, plus, because it's tied with FHA, 3.5% down payment, a 1.5 towards closing cost, and the seller paid 6%. People were walking away from settlement getting their earnest money check back.
Yep.
Think about that. Buy a house, check back. Buy a house, check back. Pretty much everybody can qualify. Now, it's a little tough now because sellers aren't paying that. But once again, we talked about it at the start of this, when the market what? Normalizes, right? At some point in time, sellers will go back into it. Now, the way I did this and the way we did this, right? Historically, sellers would pay 3 to 4% in closing costs. I didn't ask a seller to pay 6%. What I asked the seller to do was say, hey, if I could give you a contract where you would net exactly what I told you would you be willing to pay 1 to 2% more in your seller help? Oh, yeah, I guess I would. How am I going to do that? I'm going to raise the sales price by 1 or 2 points, and then you're going to give a 6% seller concession. You're going to net out exactly what you had, right? So this was happening. Natish will tell you, we closed hundreds of people that brought nothing to the table. Does that happen in 21? No. Is it going to happen in the early part of 22? No. But at some point in time, it is. So think about how many people wanted to buy but didn't have the money, that if you gave them this option, when the market normalizes, they're going to be ready to buy. And that's really what we want to talk about.
Yeah, and I'll give you a great example, Cindy. The very, very first deal I did with this program, the agent actually came to me because I want to say buyer, but they weren't a buyer at the time. They actually went to the agent because they were looking for a rental property. They wanted to rent, their lease was coming up, and the agent, reached out and they were like, hey, the only problem this individual has is money. They had great credit, they had great income, and they didn't have the money to buy. And the agent was just like, it doesn't make sense for you to rent again. Let me figure out a way to get you into a home. Reached out. We had just rolled this program out. I want to say it was around 2016. And we had just rolled this out. And I was like, man, perfect timing. Let me get this borrower qualified, pre-approved them with this program. They put a $4,000 earnest money down, right? And they actually, because they didn't have the money, they had to get a gift from a family member to put the $4,000 down. The grant was provided, and they actually got seller credit from the sellers. Now, of course, as Brett mentioned, it's not happening now, but when the market normalizes, that will happen. It was a I want to say it was around 440 or 460 $1,000 property. They went to closing and got the entire $4,000 back. They walked into the property. They only paid for the appraisal.
Oh.
They got the entire earnest money back. All from someone who was looking for a rental.
So let's talk about how that works.
Yeah, everyone can buy. So, here's a small comparison. Standard FHA, you're looking at a $420,000 property. Loan amount is $405,300. The upfront MI and everything together, looking at a total loan amount of $412,393. 3.5% down payment. With a regular FHA program, they're bringing $24,700 to closing. But with the FHA 100, they get $20,600 to use towards that transaction. And, again, Cindy, if we gave you $20,600, what would you say?
Thank you.
Thank you very much. Right?
Absolutely. So think about this. When we deal with challenge credit people, right? You say, hey, you got your credit above 640. Great. All you need is 24,000. That's deflating. Yep. Now you say, hey, get your credit to 640 and we have $20,000 waiting for you. They get motivated, right? So we want to keep people motivated in the process. So what about the payment? How does that work?
Yeah, here's another comparison. We say 4.5% right now for a regular FHA, but as you've seen in the market, interest rates are starting to climb. But interest rates should not be the focus. It's affordability. You're paying rent. What is that rent doing to you? Nothing. It's not an investment. You're making your landlord rich. So why not buy using other people's money to make yourself rich? Instead of paying someone else rent, pay yourself by getting a mortgage. So at a 4.5% interest rate, your total monthly payment, including taxes, insurance, everything put together, comes out to about $27.92. Now, the program currently offers an interest rate of 5.5% for anybody who's partaking in the grant program. At 5.5%, yes, the payment is a little bit higher. It's at $32.32, but that $3,200 is going to yourself. Instead of paying your landlord, you are now paying yourself. It's going to take 4 years to make up that money if you put the money out of pocket.
What's interesting here, Cindy, and I think people need to understand, right? What we're trying to do is take the money out of the landlord's pocket and put it back in your client's pocket, right? Every time a renter makes a rent payment, the landlord gets more wealthy, right? Every time your client makes a mortgage payment, they build wealth. Now, I'm fortunate enough that my family was in real estate. So when I bought my first house, I've kept everything as a rental property. So I have tenants, and every once in a while they'll say, "Hey, Mr. Carter, I see you got a home buyers event on Saturday." I'm like, no, I don't. Are you sure? I think I saw that on Facebook that you're doing a home buyers event. No, it wasn't me. I don't want them to buy. I want them to keep paying me rent. Right. So I don't let them come to my events. No, I'm just kidding. I let them come. But the reality is most landlords want to keep people paying them. And it's really more important now because what's happening in the marketplace today. And let's talk about waiting and the cost of waiting. So rent inflation is one of the biggest inflation issues, right? I already talked about it. Rent will continue to increase. According to the Single Family Rent Index, SFRI, rents are increasing at 4 times the rate they did in 2020. And we know rent increased in 2020 and 21. There's increasing demand for rentals. That's going to continue to drive rents higher. Airbnb, right? Other reasons for people to rent. So that's pushing rents up at an accelerated rate. Rent is becoming less affordable than owning, right? We know that for a lot of reasons. Rent's going up. You get no tax benefits in renting either. Now, renters are also starting to look harder to find larger homes, making owning more attractive. What's happening there, Cindy? A lot of renters now are starting to have families, so they're trying to step up into single families. At the same time, the market's superheated. Now, supply and demand becomes an issue, and that's pushing up rents higher. Here's the other unintended consequences. Landlords are raising rent to recover losses due to COVID-19 pandemic. We talked about forbearance in another class, is that people didn't need to make mortgage payments. Well, in certain states, people didn't need to make rent payments either. That crushed landlords. So they're saying, oh, you know what? We're going to raise rent to try to recover that. That's one of the unintended consequences. So rents are driven up higher for that. Real estate investors are going to benefit as renters will have to pay more. So that's pushing more investors into the market, which is pushing rent higher. Low inventory, high demand will hurt renters. Supply and demand matters. Is there a supply chain challenge in real estate? Yes. We hear about supply chain and everything else. Well, there's a supply chain issue. Now, we already know inventory is an issue in buying. Inventory is an issue in renting as well, and that's pushing rents up. So what I always tell people this, especially with real estate, the longer you wait, the more money you lose. So why are you waiting? So the real question we should be asking our clients is simple. If I could show you how to buy a home today with no money down for what you're paying rent, would you like to buy a new home? What's the answer for most people? Yes. Natisha brought up a great example. If first month's rent and security deposit could help you buy a home, why would you rent, right? The challenge is most people just don't know that that's there. And we talk about this from a financial planning standpoint, opportunity cost, right? I'm going to rent. Okay, what's my opportunity cost? Because I think rent's safer, it's cheaper, whatever. Well, my opportunity cost is this. If I rent and I don't buy, I lose out on appreciation. I lose out on the tax benefit. I'm not building any net worth. I'm not creating any equity by making my payment, right? So there's an opportunity cost. If I wait, I lose all of those things. And what's really interesting, Cindy, and this is why we want to trust people to buy early, is that 70% of the average American's family's net worth is tied up in real estate, right? The longer you wait, the more money you lose, right? Real estate values keep going up. Mortgage rates are going up, which means real estate gets more expensive. Everybody that wishes they would have bought in 2019, right? In 2022, they really wish they would have bought, right? Even if interest rates were higher in 2018 or 2019, they still would have made a better decision. So what we want to do is encourage our clients, regardless of what the challenges are, that the earlier they buy, the more effective they're going to be in the first step to financial freedom as they're going to take. So let's talk about building your prospect funnel.
Well, Brent,
Let's
I
start.
want to I want to touch on something that
Yeah.
you do another class, which we hopefully get to do with Downing-Frye soon, about overcoming objections. And
Yes.
one of the objections that real estate agents get a lot is when you're talking to someone and seeing if they're interested in purchasing, they say, "No, I'm happy where I am. I just want to continue renting." Well, are you okay with the increasing rent prices, right? Maybe you have a 12-month lease with 4 months left on it, but likely at the end of those 4 months, your lease is gonna go up. Your rent prices are gonna go up. Are you okay with that? Are you okay with spending $150, $200 extra next year,
Tish,
right?
it can be more than that. I have a friend of mine.
Absolutely.
She was renting. Her rent was $2,400 a month. Her lease expires next month. She just got her lease renewal, $3,200 a month.
Wow.
That's an $800 increase. She can't afford it. She's in tears. She called me for help, and the landlord's like, "Yeah, tough. I can get this in the market. That's what we're willing to pay. So you either do it or not." Because he's okay. He realizes that property will be leased in a month, right? So he's going to lose $2,200 or $2,400 for 1 month, but he waits a month and he's going to get $3,200, right?
Yeah.
So
That's
he's
almost
like
$10,000,
correct.
additional a year, and income is not going up at the same rate that rent prices are. So your income is staying the same, but your rent prices are going up. How do you afford that? Well, if you get a mortgage, a 30-year fixed mortgage, well, you don't have to worry about your mortgage going up on you for the
Right.
next 30 years.
Absolutely. She's in tears. She called me. Her dad called me. I'm like, okay, I don't know what I can do to help you. We'll look at something and we're going to help her buy. But that's really what happened to her. That's a real life example. And it just happened this weekend. So, all right. So what does this mean for us, Cindy? Let's talk about building your prospect funnel, because you're going to hear us talk a lot about that in the training that we do. Create your prospect funnel, right? So we already talked about it. Any borrower who did not have the cash to buy a home in 21 may be able to buy in 22. Why? Because we have the money to help them do that. Now, the challenge is it's the time to start the process now. We know they might not take a contract now, but have your clients in a position to do that, and don't wait until the market turns. That's too late. We want to build them now and keep them motivated. So have them reach out to us. Let's start that home ownership plan. Let's show them what money's available, get them motivated, so when the market turns, they're ready to make an offer. Now, speed wins. I think this is really important. What you want to do is you want to re-engage these prospects now, because if you don't, there's no guarantee they're going to re-engage with you. And then you want to address any challenges, since credit, debt, DTI now, so your client is ready to buy when the market normalizes. And then don't wait to begin the process, right? You don't want to be in a situation where you don't have prospects when the market turns. You want to have them now. It might not be an April opportunity. It might be a December opportunity, but I know everybody listening to this call, they're going to want to sell a house in December. So why don't I start building the prospects to help us do that? So that's what we're talking about today, Cindy. There's money available. Move the money, make the deal, show them the money. We're all Jerry Maguire today. Show them the money, make the deal happen, start building your prospects for the latter part of the year when the market turns.
Natasha, you're too quiet. I need a show me the money from
Show
you.
me the money. Hey, there's enough funds to go around, and it's been successful. We've created a lot of home ownership using this. It's their money for them to take advantage of, and we're looking forward to getting into that market and making it happen.
Absolutely. Well, gentlemen, just an hour packed with fantastic information. Thank you so much for your time today and helping make Downing-Frye agents more effective and more profitable in their business. And cheers. We'll see you next time.
Cheers, Cindy. So if you show them the money, then everybody can get a coffee is for closers cup, because they're going to be closing.
Precisely.
Thank you for joining us for FDM Brews. Our team is here to answer your questions. Just call 239-359-6590 or email us at dfry@fdmhome.com.